Good afternoon, everybody. Thanks for coming. This panel is on middle market private equity. I am Adam Sokoloff. I'm the global head of financial sponsors at Jefferies, and I'm happy to be back this year to moderate the panel again. Before we start, I'm just going to go down the panel. I'm going to ask everybody to introduce themselves and tell us a little bit about themselves and their firm, and then we'll get into the questions, and we'll leave some time, hopefully, at the end for some Q&A from the audience. Lauren?
I'm Lauren Leichtman, CEO and co-founder of Levine Leichtman Capital Partners. We have approximately $6 billion of capital available for investment in the U.S. And UK middle markets. We have offices throughout the United States and London, and we are headquartered in Los Angeles.
Thank you. I'm Brian Reynolds. I'm with Chatham Capital, and we're a billion-dollar fund that does credit opportunities. So we do senior debt and mezzanine debt, and we're currently raising a fund. We have $450 million of dry powder currently to invest in companies.
I'm Ted Virtue, the CEO of MidOcean Partners. We're a $2.5 billion alternative asset manager in private equity, credit, and long-short equity. And we have a large group of operating managers driving our fund, about 35 operating guys across those three investment fields.
Thanks. I'm Barry Volpert, co-founder and CEO of Crestview Partners. We're a $4 billion private equity firm based in New York. We're about 8 years old. We focus on 4 industries: media, financial services, healthcare, and energy.
My name is Kneeland, Youngblood. I'm founding partner of Pharos Capital. We're located in Dallas, Texas, with $1 billion assets under management, currently raising a new fund. And our primary focus is on healthcare services and business services, again, located in Dallas, but also in Nashville.
Great. So this panel is middle market private equity, and not everybody defines middle market the same way. I thought we'd just take a minute to get some sense from the panelists. How do you define middle market? You know, we heard this morning there was a panel on private equity, some of the larger funds. I think most people, again, define it a little differently. But Lauren, why don't I start with you?
We define the middle markets as companies 50 to 500 million in revenue size, margins about low 20s to 40%, and our sweet spot's probably companies 100 to 200 million in revenue size.
Brian?
Yeah, so we define the middle market as 25 to $1 billion, but we play in the lower middle market, so enterprise values of 70% of them less than 100 million, and 30% of them less than 300 million in enterprise values.
We target in our mid-market space kind of the small end of the market also, sub $500 million enterprise value companies. We think that there's real inefficiencies, and there's real concern about liquidity across both the debt markets, the public equity markets, and the private equity markets. And so we believe there's could continue to be great value across the lower end of the mid-market space.
I think you're going to hear all of us talk about how attractive the mid-market space is. I looked at our portfolio as a way to define what we think of as mid-market, and it's essentially companies with enterprise values between 200 million and 2.4 billion.
You know, I would say that, you know, middle market is defined lots of different ways, lots of different people. Certainly, there's a size component, sub 500 million, you know, fits our criteria. Having said that, you know, again, I think institutional investors look at it one way. I think, you know, GPs look at it another way. I think that the banks and others in the financial services market look at it a whole nother way. So what we do know is probably more relevant, which is what's the mega buyout, you know, space. And again, that I think everyone knows when they see that.
So Barry, this morning in the larger panel, what was very clear is that the level of activity in terms of private equity, there's a lot more going on in middle market right now than there is in the larger mega funds. What's going on with your fund? What are you seeing out there? How would you describe the activity level overall?
So I would say we have more activity in our portfolio right now and less activity in terms of new deals than we wish we had. And it's all driven by the public equity market which is so strong right now, and the credit market, which is just unbelievable. So the first thing that we're doing is we're refinancing any place we can because it's just compelling to take advantage of the current low rates and the current weak terms in the credit market. And so that's driving a lot of activity and keeping our team very busy. I'm sure we'll touch on that in greater detail. But in terms of new investment opportunities, for the same reason that the market is so ebullient right now, there are just fewer attractive investment opportunities than we would have expected.
Ted, we clearly see that in terms of what's going on out there, the reality is that there hasn't been quite as much new deal activity as we'd expect, given how strong the financing markets have been. Mm-hmm. What's behind that, and how do you differentiate it, if at all, between middle market and what the larger funds are seeing?
Yeah, we've been actually incredibly busy we bought three new platforms in the last 4 months. So I think in the middle market space, we're continuing to see a good flow of private companies, secondary deals from buyout shops. There were a lot of tax selling going on at year end, or tax concerned sellers selling at year end. So we've been as busy as the last 6 months between, just like Barry, refinancing almost every company, recapping companies with the incredible debt markets. And it's obviously a great time to sell companies today also. You'll never get a more ideal opportunity where it's both strategic buyers loaded with cash and flexible balance sheets, foreign buyers in the marketplace today, financial buyers obviously, and then the ability to recap almost any company as multiples increase. It's really made great opportunities to exit and bring liquidity to your company. And we're also seeing, a reasonably robust, although higher priced, new issue market, in the new M&A marketplace for new deals.
Can we bring up slide 1? That's not what I had as slide 1. Slide 3, excuse me, slide 3. So there's $370 billion of dry powder out there, notwithstanding sort of the level of activity right now. And 65% of that dry powder is in middle market funds. And that's, I think, on slide 5. So 65% of that $370 billion is in middle markets. How will that money be put to work? And in the current environment, and given all that's going on out there, how does that money get put to work? Lauren, would you give us some thoughts?
I think for us, there are a lot of opportunities out there, but very few that are, I think, good quality. And I think that's part of that and the large amount of capital that's available is what's driving the higher multiples at this time. But I think that capital doesn't really get put to work until there's growth in the U.S. economy, because as it appears to us, the middle market, the companies that are less correlated to overall U.S. GDP returns are growing very nicely and strongly, and those are the companies, and we're in the process of selling one as well, that's getting a good multiple and a lot of interest. But I think, if you have a company, let's say in housing or construction, that's very tied to overall U.S. GDP, and the growth is pretty flat, I think you're not going to be able to sell it, and I think that dry powder is going to have to wait for these opportunities to come around.
Brian, what have you been getting a lot of inquiry? Obviously, we'll get to the financing markets in a bit, but what kinds of inquiry are you getting, and are you seeing a lot of opportunities to put money out?
Yeah, so we're seeing a lot of refinancings. There's $400 billion worth of refinancings that are out there over the next 5 years, and we're seeing a lot of that. And then in the lower middle market where we play, our deal flow that we've seen in the first year to date is up 120% from last year. So we have a lot of deal flow in, and a lot of it's concentrated in the last 2 months. It seems like everybody took a break after all the tax deals at the end of the year, and now everybody kind of woke up and are doing transactions. So we're seeing an awful lot of activity, and we're very pleased with the deal activity.
Ted, at the end of 2012, or as of the end of 2012, there were more than 6,500 companies in private equity portfolio companies. that were acquired between 2005 and 2008. So companies that have been held now for quite some time.
Yep.
What are LPs thinking about this? We can talk about sort of what's going to cause those companies to come out or change hands.
Yep.
I'd like to talk about that, and also getting a sense of, are LPs anxious about that? What are they saying?
Yeah, I think the normal 3 to 5 year investment horizon that we all probably invest around was stretched out a little bit in 07 to 08, 09 when people were really protecting balance sheets, and so we lost 2 years of growth and liquidity alternatives for companies. So we do have this overhang still in the marketplace, and certainly LPs want money back. They put out a lot of money in those 3 or 4 years, and I think as people go back fundraising, they're going to want to see some of these companies sold. But I think as a GP, I think a lot of people are holding companies longer to get back to that growth, those lost 2 years. So the average hold period has probably gone from 4 years to 5 or 6 years over this cycle, and it's now normalizing. So I think we'll see a lot of those companies up for sale, which is, we're looking at a bunch of secondary buyouts right now, which we typically don't, because there are some forced sellers in the private equity community who need to sell some of their companies to return it to LPs.
Barry, any thoughts there? You can bring up slide 6, by the way, as Barry speaks.
Median holding period. Yeah, I agree with Ted. I think, in effect, the funds that were invested just before the financial crisis and the funds that were invested just after are all going to be harvesting at the same time. So you're going to have twice as many exits as you might have in a normalized period because investments that were completed just prior to the financial crisis were impacted by the financial crisis, and so people generally hold longer. And the interesting question to me is on these secondary buyouts. You showed some data that 17% of all buyouts now are secondary buyouts, and I think that was it slide
7.
Slide 7. Okay, so if you compare the perspective people have on these secondary buyouts today to what we all thought 10 years ago, I think there's been a big change. And I think the view 10 years ago was that buyouts of buyouts were in effect inferior investments, and that the first firm generally got the best returns and later firms did less well. And I think what you're seeing now is that because of the impact of the financial crisis, the longer holding period, the desire for liquidity coming from the LPs, a lot of very good companies are going to be sold. And to your question of where does that equity go, the dry powder, in effect, a lot of it's going to be recycled to LPs replacing the equity in those same companies held by other GPs. And then the question is, what does that mean? And there's a slide here, I think it's 68, sponsor-to-sponsor returns, which our friends at Bain & Company prepared. And it's hard to get your arms around the data, but what they're basically saying is that on average, the returns of buyouts, secondary buyouts are a little bit worse, but the volatility and the standard deviation of returns is a lot lower. Because companies that have been through an LBO understand managing for cash flow. And so the second time around, the management team really knows what they're doing. And so you have the benefit of an experienced team operating with leverage, knowing what they're doing, offsetting the detriment of not being first.
Kneeland.
I just wanted to follow up. I think part of the issue with regard to the longer hold period from an LP perspective, I think they've come to the conclusion that they're going to begin to invest in fewer firms, putting more dollars in, which is really going to squeeze, the firms that can't exit and get great returns. I mean, it's almost a vicious cycle. The fact that there's now a longer hold period, LPs are saying, you know what, time out. I can't accept that type of trajectory. We're going to cut the managers who can't seem to exit in good times and bad times and really invest more capital in those firms that can. And so I think that will have, as you're seeing now, longer fundraising for funds, trying to get raised. And also, whereas firms raised $10 billion before are raising $3 billion now, or raised $750 or raising $500 now. And that's just the change in the landscape, at least for the immediate time in the fundraising space. because of the longer hold.
Right, right. Brian, you want to say?
I think some of this is going to clear up because the data is that 50% of those deals in overhang were done 2005 to 2008. So if you look at a normal, our normal now 5-year hold period, those deals are going to cycle through. The LPs will be paid down. Their allocations will be under-allocated. And so I think it's going to cycle through a little bit. And we'll see that in the next couple of years.
So let's talk for a minute about these companies, longer hold periods, management teams that have been in there for quite some time. In some cases, it may be the economy. In some cases, it isn't. Lauren, what when it gets to the point about things aren't necessarily going the way you want them to go, how do you feel about changing management teams, and how do you go about doing that, and what's your experience been there?
Well, I think our investment strategy is a little bit different. We're not an LBO firm. We only invest our capital in companies where management wants to retain or increase the amount of equity that they're holding. So I think we feel we have a little bit of a bias in terms of good performing management teams because their entire life is invested in these companies. We invest with managers who've operated these businesses for the past 10 or 15 years. We're not asking them necessarily to do anything different than they've been doing. Sometimes we'll do a corporate spin out where management puts money in where they've been running the company for someone else for 10 years. So we do have in place the ability to foreclose on our manager's equity. We invest, which makes our LPs happy. We get a current return on our investment in the low teens throughout the life of the investment. So we can foreclose on the equity of the company if we need to through our documents and kick management out, but that's a very rare occurrence. We think that if we have to do that, which has happened a couple of times, that we've picked the wrong investment to make.
Ted, is the DNA of a manager at a middle market company different than at a large cap company?
I think for most of the companies, in every company we buy, we enhance our management team or change out our management team. So it's a different, we have this big reserve of 35 operating executives just to bring a new set of eyes and a new set of experiences to small businesses that don't have all the skill sets to do what we want to do in globalizing these businesses. So for us, that's one of the core DNAs of our firm is to have, Steve Miller's in the front row here. Steve's our chairman. He's run, 11 or 12 public companies in the United States. And, to bring him into a small mid-market company is transformative in terms of the skill sets they can bring to small businesses and trying to grow them from $200, $300, $400 million in sales to $1 billion companies. So it's one of the attributes I think we all can bring to our companies and successfully do that, whether it's buying a family business or buying a secondary business from a private equity firm.
Can I just add one thing? For us, it's interesting that we have different perspectives. For us, my experience over the last 25 years is that the management in these middle market companies is like the engine of the car that drives it forward. And we use our financial sponsorship to enhance that performance. And where we do a good job, companies certainly double their EBITDA over the life of the investment.
I want to get a little bit toward talking about, again, middle market private equity versus some of the larger players. Barry, talk for a minute about what kind of IRRs or ROIs that you're targeting when you're making investments. And then I want to talk a little bit amongst the group about how sort of that compares to the way some of the mega funds approach, many of whom are public companies today, and a lot of people argue are more about AUM under management and fee streams than they are deal shops, so to speak.
Yeah, well, it's a great question, and I think in this panel you're going to hear a lot about why middle market is better than mega funds in terms of returns. And certainly the data, I think, is consistent with that. If you look at, what is it, slide 18 as one indicator, yeah, it's hard to get accurate data, but all the data that we've looked at shows that mid-market buyout returns exceed mega fund buyout returns over any reasonable time frame. We grew up in this business targeting net double, net 20 as sort of the gold standard. And something like 1 out of 5 funds do that. in the current environment with interest rates near zero, it's hard to get to net 20 returns on a consistent basis. And I think we're targeting high teens net returns and net double still. And that's a huge contrast versus the mega funds, because the mega funds are basically trying to get to net 12, because the major LPs are saying if they can get net 12, they're happy, and that's what they're looking for. And you can see, given the recent market impact, it looks like the middle market funds overall are at net 12, and the large cap funds are lower than that. I would expect that we'll start to see some improvement in returns over the next few years, partly if the economy does better, partly if we start to see interest rates increase. But for sure, the alignment between the middle market GPs and the LPs is just stronger, because at firms like all of our firms, the GPs are not in other lines of business and have a huge capital commitment, whereas in the larger firms, essentially a large part of the GP's economics comes from the capitalization of the fee stream into the public stock values. And so optimizing the GP's economics at a mega fund is basically what you do by growing. And optimizing the GP's economics at a mid-cap fund, you achieve by generating the highest ROIs.
So one of the things you said there was that basically that the mega funds can underwrite to a lower IRR as per what their LPs are looking for. What does that mean in the context of some of the mega funds dipping down into middle market deals when there aren't as many large transactions going on? Does that mean that you're at a competitive disadvantage because they in essence can, their equity is cheaper than your equity? Kneeland, do you have any thoughts on that?
Yeah, what I would say is I think some of them have approached it in different ways. Some of them have raised separate funds, quite frankly. We've got our mega buyout fund and we've got our middle market fund. The truth is, I think at the end of the day, excellence wins out. And I think this is a space we've all been in for, decades. We have a set of relationships throughout the marketplace that I think, quite frankly, over time, advantages us relative to, our mega peers. I think from an institutional investor standpoint, clearly it's much easier to invest in a name brand fund because, of course, at the end of the day, what they don't want to do is get fired, and whereas there's maybe greater opportunity for headline risk in a smaller fund. Having said that, there's much more pressure on institutional investors given the return assumptions and the funding deficit that many of them are facing. And so increasingly, I think the emphasis is going to be return driven. And I think that advantages all of us. And to the points that Barry made, we simply have more skin in the game. We're, more motivated, and the returns really reflect that.
But Adam, I think you're right. To the point you made, if the largest funds are bidding to a net 12 and we're all bidding to a net 18, they can pay more for the same company if it's a level playing field, for sure. And so the challenge for all of us is to figure out how to make sure that it's not a level playing field and that we create unique opportunities through relationships with owners, relationships with management teams, a perception that we can add more value, a perception that we'll care more because we're committing, 5 or 10% of the fund's assets to one deal and 5 or 10% of the firm's assets to one deal as opposed to 1% or 0.5% or 10 basis points. And I think part of how we can achieve superior returns over the long haul is by creating situations through hustle and relationships that allow us to create investment opportunities where we're not bidding to the lowest return.
I agree, and I think that, what Kneeland is saying and what Barry is saying is true. One of the things you hear a lot of talk about the large cap funds coming down into the middle market, but I actually don't see them. When we're, competing for an investment, I don't see a large cap funds on the other side of the table. So I don't know how they're defining the middle markets. We try to differentiate and have an edge for ourselves by only selecting those management teams that want significant equity in their companies. And that helps us, we think, get to the ROIs that we want.
I think in M&A land, where we see the mega guys coming down, tends to be for high growth companies, as well as sectors where they have platform companies and they're tack-on or add-on acquisitions, or maybe buying something for a platform and looking to put more capital to work over time. But the biggest area is growth. We've seen guys come in, all equity kinds of transactions, $10 billion funds, writing a $200 million check for a high growth story.
Can I just add one other thing? What I would say is this, because this is not the mega buyout funds have really done us all a service. I mean, because of the success that they've had, it really has provided, leadership in terms of institutional investors looking at the asset class and really understanding that in order to hit their actuarial returns, they need to have a presence in this space, certainly relative to the S&P and other asset classes they can invest in. And so, not all, mega funds are created equal. And certainly what I would say is we've had the good fortune of, as I'm sure we all have, of co-investing on some of them, on some of the deals that they've made, or selling some of our companies to them. And so they've played a very good and important role in the private equity space.
Ted, I want to talk for a minute now about the financing markets. I mean, we can't lose sight of the fact that these debt markets are about as robust as we've seen them. Leverage has continued to move up, but it's not just that. Pricing's come down, terms very user-friendly. What are you seeing out there? I know you have a credit background as well. What are you seeing out there, and what does it mean for private equity? How has it impacted your business on both the buy side and the sell side?
On the buy side, obviously, we're back to near 07 levels in terms of flexibility and capital structures. So, no covenants, leverage that's, certainly for larger cap deals, 6.5 and 7 times. One of the barriers to entry in the mid-cap space that we all face is there's still, and Brian lives it day to day, there's inefficiencies in the small cap world. So, when you get below $300 million or so in enterprise value or less than $200 million in financings, there's a big disconnect in the marketplace. The big banks don't underwrite that paper, and it creates a barrier to entry and lower multiples, we think, in purchasing. So, it's much more work for all of us to put a credit facility together. You have to call up, Brian and 3 other guys to kind of put together a financing. But we think we're buying companies at 20 or 30% discounts because we're not in the efficient part of the capital structure. The good news is if we grow our businesses, we get that multiple expansion as we get more into a larger cap company that can get easily into the syndicated marketplace. On the sell side, it's creating a lot of buyers for us that we wouldn't otherwise have at higher prices. So when we get, we're selling 2 businesses right now, when you're getting 6.5 and 7 times staples on businesses, it gives you a much higher exit price as a stable platform bid from the larger cap private equity guys. So very liquid markets. I doubt they're going to stay as robust as this. And we're certainly not going to see where, we can get cap structures financed at 5 or 6% all-in rates for small and mid-cap deals.
Brian?
And you can turn to slide 29. And if you look at the collapse of the parallel banking market through 2007, it was more difficult to finance transactions from 2007 to 2012. In 2012, the CLOs have come back with $54 billion worth of issuance and an increase in the first quarter of 2013 to $26 billion. So there's more capital there, financed by the CLOs, which is cheap financing, and they're trying to put money out. The BDCs have increased, so they're coming through with lower cost financing, and the banks have opened up the gates. They were sitting on a bunch of equity, and I think the Fed may be pushing them to do more transactions. So in the larger market, they're opening up the gates. But down in the middle market, or lower middle market, where we play, and we write a $10 to $40 million check, there's very few players there because they don't have access to this capital at this point. So we're in a good part of the market, but there's a lot of capital now to refinance transactions at very low rates because of this, because of what's going on in the CLO market.
Slide 12. Lauren, I touched on this briefly earlier. The reality is that despite the strong markets that we're seeing on the financing side right now, only 12% of the financings done in the leveraged loan and high yield market for sponsors year to date have been for new deals. Are you, a lot of people have tapped the recap market. Every time we think you can't recap anything anymore, we see that happen again, repricings. Are you seeing that in your portfolio?
Tremendously. I mean, we just recapped a number of the senior loans in our portfolio. Got 100 basis points off on every one of them, even ones that we had just financed a year ago. So I think the reason that there's, people are doing recaps as opposed to sales is because there's no growth. So if your EBITDA is staying relatively flat and you're able to use those dollars to deleverage, you might as well recap it and give some money back to your LPs.
And we certainly saw a lot of that in 2012, and it's continued into 2013. Kneeland, you, in addition to your private equity career, you sit on a number of corporate boards. Maybe share with us some insight into what's going on at the board level. These companies are sitting there with tons of cash on the balance sheet. Borrowing costs are next to zero. They're earning nothing or next to nothing on these cash hoards. Some of them are paying special dividends, but most of them seem to be hoarding cash. What's the mindset at the corporate level? And we're not seeing a lot of divestitures happen as well. So what's going on there?
I think for a lot of companies, they're looking at global opportunities, and they're looking to use that cash to expand their presence, whether it's in Asia, Latin America, even in frontier places like Africa. But I think they're looking to try to invest for the future. They're trying to leverage the dollars they have because, again, for the reasons that you just articulated, there's no growth, in terms of being able to get yields on the cash that they have. So I think they continue to look for opportunities overseas, looking to invest with great partners, looking to acquire companies, globally, and really try to position themselves for growth in other, emerging markets.
Barry, you've done corporate carve-outs in the past. What's your dialogue? I know you're always talking to strategic big players out there in various industries where you focus. What are you hearing from them? What's the dialogue like about, the ability to lift out some of these assets? Is it tougher? Is it sort of business as usual, or what's the mindset that you're seeing out there?
Well, our dialogue with corporates is more trying to convince them to buy our companies on the sell side, where there's potential synergy, and we're hoping that we can share the benefits of the synergy. And that's obviously a big part of the mid-market story, in effect, is to buy at a fair multiple and sell at a higher multiple to reflect the capitalized value of the synergies. In terms of creating carve-outs for new investments, we just completed or just announced one. Victory Asset Management, we're buying from Key Bank. And their decision to sell had nothing to do with us. They basically reached the decision they needed to redeploy the capital, and once they had made the decision to go, then it was just a question of executing as efficiently as possible and as cleanly as possible. And that's a favorable scenario for us. And in effect, I think for corporate carve-outs, what we want is to buy a company which is very small in relation to the assets of the seller, so that they're more focused on smooth execution, no surprises getting it done, and less focused on dragging out the process in order to get the last, the last dollar.
Ted, any thoughts from you? Can you bring up slide 38, by the way?
Yeah, I think we're buying a division of a company today. It helps when you have we have a bunch of platforms where we're a logical buyer for strategic assets from divisions of companies. But like Barry, I think we're spending more time thinking about how we can sell our businesses into large cap companies. We're sitting with enormous cash, enormous amounts of borrowing capacity, and they're looking at things, at least we see a lot of companies, not only accretive to their stock, but accretive to their cash, which is earning nothing. So a lot of them are very aggressive in terms of trying to build their businesses and buy, the 6,000 plus companies from private equity firms.
I mean, this is the real problem, is if they sell you anything at a reasonable multiple and use the cash to build their cash balances, it's dilutive, right? So the only way a corporate carve-out is accretive is if it's really underperforming and they think someone else can do better. If it's really a headache and they just want it off their table, or if they can buy back stock cheaply or fund an acquisition. And with the market strength, the public market, it's just harder to make that analysis work.
Flip side is, given how they're earning nothing with that cash, as well as where the stock market's trading, so many of these deals with those folks acquiring businesses are accretive.
Anything at any price.
Right.
I would also say the shareholders, of course, are putting much more pressure on corporations to dividend out that cash, return the cash to shareholders. I think that's the other component.
You touched on public markets. Clearly, the IPO market is something that we've seen reemerge over the last many months, and I think many sponsors are looking to utilize that market as a potential monetization, if not, selling 100% of the company day one, certainly getting it out there and either riding the cycle or growth companies. How often are you looking, Lauren, at the public markets when you're thinking about exit? Is it a real alternative for you, and how do you think about it?
For us, it's not. It used to be, but I think the unintended consequence of government regulation and Dodd-Frank really hit the lower end of the U.S. middle market. So I think if you're a company doing $20 to $40 million of EBITDA, I think to spend $3 or $4 million of that going public and staying public is just not a prudent use of their capital. So unfortunately, where it used to be a viable exit, we really don't see it that way anymore.
Mm-hmm. Ted?
I think we look at it for all of our companies as an alternative. It's not ideal because it takes longer to exit for some of these mid-cap companies, and there is some more friction cost amongst that. So most of our companies are geared towards trying to find a strategic buyer. We build it to a scale of efficiency, and then we try and move it out to a strategic or financial buyer. But for growth companies, I think you see, if you have a really good growth business, we have a great pet food business that's growing fast in 60 or 70% a year. That may be a better exit in the public marketplace, as they will give you a higher value for future earnings and future growth, better than probably private buyers today.
Barry?
So we did an analysis recently of our cumulative distributions, and what we found surprised us, which was that it was about a third dividends or recap proceeds, public market proceeds, and M&A proceeds. And I would have predicted, and I still predict going forward, that the M&A portion of that will be higher. Because as Ted said, it's cleaner, you get your proceeds sooner, and frequently you get a higher valuation. But in this environment where the public market is attractive at the upper tier, let's say companies that are earning at least $100 million of EBITDA, it can be a good option. And especially it can be a good option in situations where you don't own 100% and you're trying to solve for more than your own fund, but you're trying to solve for a company where maybe the owner wants to stay in, or there are family issues or trusts or whatever. And a public offering can allow for flexibility on exits for different constituents.
Let's move to fundraising, talk a little bit about the fundraising environment and what it's like out there. Kneeland, what can you tell us? What are LPs thinking? What do they want? What don't they want? And how tough is it?
Well, certainly it's better than it has been. That's for sure. I mean, 2009, 2010, were brutal years. 11 was a little bit better. 12 certainly was better, and it's improved. Having said that, institutional investors have not forgotten about 2009, 10, 11, and therefore they are looking for, distributions, first and foremost, number one. Number two, they want very good returns. Number three, I would say that as a GP, I think, we've maybe relied a little bit too much, or some of us have relied a little bit too much on the public fund market. And it's very important to diversify one's LP base, whether it's Taft-Hartley funds, whether it's high net worth family offices, whether it's endowments, foundations. Again, it's more difficult to attract sovereign wealth funds just because of the size of the check that they write. Having said that, we should and at least we are, developing those relationships long-term, because they've also come to understand that they need to diversify their GP base if they want to, generate very good returns. So I think, as a GP, it's one approach. As an LP, again, I think they're going to have fewer managers. They're going to write larger checks, and I think that it's going to create a shakeout in the private equity market for many firms, kind of across the sphere, both on the large side as well as throughout the private equity space.
Barry, what are your LPs telling you?
So I think it's a much better time, as Kneeland said, to answer this question than it was a couple of years ago, because when we look at the macro picture, the private equity returns have been superior to any other asset class over any reasonable period of time.
With the exception of mezzanine. But.
Okay, but, $150 trillion of investment assets, the trillion that's in private equity is performing 400 basis points higher than absolute return, which is another couple hundred basis points over anything else. And so, notwithstanding the challenges that we face as an industry and the politics and so forth, the only reasonable way pension funds can generate 8% net returns or anything close is to have a good private equity allocation. And with the run-up in the market, the denominator effect that we were all struggling with is going our way, where they're getting more distributions than they expected, and the value of their underlying funds is bigger, so their percentage allocation is much less than it was a year or two ago. So that's the bright spot. What we're hearing from our LPs is number one, what Kneeland said, they want to have fewer, larger commitments. They don't want to manage 100 relationships, they want to manage 30. And so they're going to pick 5, 10, 15, however many it is, depending on the nature of the investor, and double down on those managers and stop funding everybody else. And how they pick is a function of returns first and foremost, for sure, but they are increasingly sophisticated, I think, at looking at returns by year, by vintage. How quickly did you invest the fund? Was it invested before the crash or after? And we're finding a lot more attention being paid to organizational issues. They want to understand the plumbing of our firm, how the economics are shared, how people are being rewarded, compensated, promoted, evaluated. They want to make sure that the finance, legal, administration function is outstanding, that we're registered with the SEC, as I guess all of us probably are right now.
Yes, we are.
And that we've got a serious compliance function. And the truth is, they're making 10-year commitments, and those are all perfectly reasonable areas that they should focus on.
The other piece I would say to this is the terms.
Yeah.
They're also saying, in exchange for you being, the good news is you're the winner. The bad news is we're going to squeeze you in terms of terms. And so that's something that we collectively and individually as firms have to decide whether it's worth, accepting some of this capital on the terms that folks are trying to negotiate.
I think the good news is, money is flowing back to private equity, partly because they're very, good returns of outperformance, both of the category as a whole, and I think we're seeing a lot of funds focusing on the middle market as a real area. As you can see, the outperformance of middle market is driving a lot of pension funds to look at middle market who otherwise just played in the mega category. I think the challenge is, as people have said, the concentration of capital is going to fewer hands, and they're trying to put bigger checks out, and that's just a hard play around middle market. So they all say, I want to invest in middle market, but when you're a $500 million to $1 billion fund, some of these big sovereign funds and state funds, you just don't have the staffing to do 20, 30, 40 investments. And so, they end up defaulting back to the large cap funds, which is where they can put their large checks and have a concentration of funds where they can put out $200, $300, $400 million.
So or should we expect to see half the number of private equity firms 10 years from now than we see today, given what you're talking about?
There's certainly very few new funds starting up, and there's going to be a winning out of funds here over the next couple of years for people that don't perform.
I think the other component that institutional investors are looking at in order to enhance returns is really on the co-investment side, where, again, they'll make a commitment to a GP, but then have an allocation set aside to be able to kind of invest as a co-investor with no fee basis. And I think that's a way that many of them are looking at kind of enhancing their returns to augment, the commitment to the GP.
Yeah, we've certainly seen more transactions where, as opposed to seeing sponsors team up, the LPs much prefer to get those co-investment opportunities. They're not paying, fees or carry on it. And all our clients are telling us that's what the LPs are looking for, especially, in the context of a fundraising discussion. Bring us those kinds of opportunities.
The question with the LP co-investors is their adverse selection. And there's a lot of data now on how those deals have performed overall as a group. I saw a report HBS did recently which said that LP co-investments within 30 miles of the headquarters of the LP are the highest performing type of private equity there is. And LP co-investments otherwise are the lowest performing, lower than the commitments as LPs. Because it seems like the biggest deals are the ones that get syndicated that tend to get lower returns system-wide.
Let's move to, I want to talk for a second about, just the economy in general and the impact on how you folks manage your business. We're in an environment right now where interest rates are, at or near all-time lows. There continues to be, the government, pumping money in there and keeping rates low. When you're looking at businesses today, I don't know how long you think that continues, but are you managing your businesses? Are you buying businesses and taking that into consideration? What happens when interest rates start moving up? How's that going to impact your business, and how is it impacting how you're managing your business today? Lauren.
Well, I think when interest rates rise, and they will, I don't know when, maybe in a couple of years, it certainly will take cash out of businesses. It'll slow the growth of businesses. Maybe it'll reduce multiples. If you're a buyer, maybe that's good on the multiple side. We try to invest our capital in the most tax-efficient way as possible for the company. As I said, a meaningful portion of it is invested as debt, so it pays a current interest, and that's a very tax-efficient structure for the company. I think the less, again, I hate to keep repeating this, but I think the less correlated the company is to overall U.S. GDP, the less you're going to be affected by these macro factors. There's not that much you can do about rising interest rates, right?
Brian, as you're putting money out, are you thinking about that regularly, or?
Yes, and what we do is we price everything on a floating rate basis. So from our standpoint, if rates go up, we're going to make more money in our fund. But we have to be careful that the companies are not too levered so that they can't afford to pay the interest rates. So I think if interest rates go up, leverage is going to go down in the capital markets, and everybody's going to adjust. And we've done this for over 6 cycles here over the last 30 years, and it'll happen again.
Yeah, I agree. I just want to add, we keep our leverage at about 4.5 times total debt to EBITDA, so that will help in that environment.
Ted, how much do you let macroeconomic thinking impact what you're doing and how you're investing?
And we tend to buy very stable businesses, so we're trying to buy businesses that can grow through cycles, that are not GDP sensitive type companies. So we're buying good stable businesses where we can go in and transform those businesses, bring great operating strategies and managers into those businesses, and grow them at multiples of GDP growth. So we don't spend a lot of time trying to be predictive around the economy. We're obviously we're very conservative around our balance sheets, which we try and pay very modest prices for companies, and then really bring in good management strategies and try and transform their growth. So we don't spend a lot of time on where interest rates are going as a barometer of what to buy or what our forecast is on GDP growth.
Barry?
We probably think a little more about the inflation risk than maybe the other panelists do. Certainly when we're making fixed versus floating rate decisions today, we're leaning towards fixed. You can issue high yield bonds today at 7%. And in our career, 7% leverage at 5 times EBITDA has been remarkably cheap money. And when you do the short-term analysis, you pay more for it. But over the cycle, if rates increase, that can be very, very attractive. We're also thinking about commodity prices and the risk that when the Fed stops quantitative easing, we start to see inflation in commodities and we were looking at whether increased oil prices, increased other commodity prices will have an impact on our companies. We're trying to find opportunities where we think there's kind of optionality on inflation, and that in the event that we have significant inflation, we will benefit. And particularly in the energy sector, we think if you're long oil, based on the current forward curve, that's pretty attractive.
Kneeland, you know, there was some tax law change at the end of last year. I think people are still concerned that we could see more. How much do you think that has impacted private equity in terms of how GPs manage their businesses? Does it affect them at all? Do they think about those things? Capital gains, carried interest, things like that?
You know, I can only speak for myself and our firm. We actually don't focus on it. We don't focus on it. We focus on doing the best we can for our LPs, for our management teams, and you know, while certainly I've been involved politically, as some of us have been involved, you know, that's just not something that goes into consideration. This is a great industry. We enjoyed, you know, I used to practice medicine. You talk about a problem. I mean, that's a whole nother world. And so
that's the next panel.
This is a great industry, and we get paid very well to do, you know, very good deals, and so I have a frame of reference that's, you know, quite different. I didn't grow up in the finance business, and look, you know, again, I think we get compensated very well. I want to get compensated even more. Having said that, I think that's on me to perform and execute, and if I do that, I'll be fine.
Barry, when you're out there talking to entrepreneurs, you know, people who have started businesses, family-owned businesses, how much are you seeing tax changes impact their thinking in the context of your discussions with them about investing in their companies or buying their companies? Anything?
Oh, I think that they tend to be very tax focused. We saw a number of transactions at year end that were motivated by people wanting to realize capital gains before the rates increased. And we took advantage of that to close deals early and negotiate what we thought were more attractive prices because the sellers wanted to get things done under the wire before capital gains went from 15 to 24%. We find entrepreneurs are hugely tax sensitive, and to the extent that we can come up with structures that are beneficial to them and beneficial, frankly, to our management teams, we try to do it. And with respect to taxation on the GPs, you know, our number one obligation is to maximize the net pre-tax IRRs to our LPs for sure, and that's what we focus on. But our LPs are 50% taxable in our case, in one fund 70% in another. So we are definitely mindful of that in trying to optimize the after-tax returns for everybody. And with respect to potential future tax law changes, you know, there's a lot of noise about what could tax reform look like. None of us really know. I think the odds makers would say the odds are there won't be tax reform that addresses any major issue, including carried interest. And personally, I'd predict that it doesn't change because disproportionate allocations of income in real estate, oil and gas, venture capital, startups, across a whole range of the economy are pretty well embedded.
We've got about 5 minutes left. I was just going to give each of the panelists a chance to sort of make a final commentary on the state of middle market private equity and any comments they'd like to make. Lauren?
Well, there are about 36,000 companies in the U.S. under $1 billion, and about 30,000 of those companies have revenues under $500 million. So, and this is done in Bradstreet data from 2011. So I think that we are in a very robust market for U.S. Middle market private equity firms. I agree with my compadres here that I don't think we should be focused on changes in carried interest tax. We're here to make money for our investors. If we do a good job, we'll make money for ourselves as well. I think it's a great time to be investing money in a middle market private equity fund.
Thank you. Brian?
Yeah, there's $368 billion worth of dry powder in the private equity business. So it's here to stay. There's 59 funds raising capital today in the private equity markets, 6 big ones. And so there's more capital coming into the market. There should be a turnover, since we have a bolus of deals 05, 08 that are looking to get exits on. There should be a bolus of money coming through on that. So I think that it's a very positive environment for private equity, and you know, hopefully we got a good 3-year run, it looks like, at a minimum here.
Ted?
Yeah, there's still a lot of growth in private equity opportunities we see. I mean, companies need the management teams we bring, the strategies we bring, the discipline we bring to grow their businesses. The world is getting obviously very global. We're buying small regional businesses that are trying to globalize and compete in that marketplace, and they just don't have the resources. So we're very bullish on the industry of private equity, in particular the middle market side, for all the robust equity markets we've had in the last 3 or 4 years. There's still a lot of industries in turmoil that need people to come in and stabilize and transition these businesses. So you look at what's going on in the education space, you look at what's going on in the government services space today, you look at what's going on in training and testing. A lot of that is going to be stabilized and grown with private equity, because the public markets the companies are either too small or they don't have the growth to drive the public markets.
Barry?
You go to slide 16 for a second. Firstly, let me say thank you to Adam and the Milken Institute for organizing this. It's a great panel, and we're in a bigger room this year than last year, which I think indicates that mid-market private equity is a little more of the flavor du jour. I don't know whether that's good or bad for us, but I firmly believe that in the middle market we can generate superior returns to our friends and colleagues who are hugely talented but are managing just much more money. And I would predict, if you looked at the funds managed by the panelists in the large cap panels here versus the mid cap panels over time, the mid cap panels are going to outperform. And why is that? It's because we're able to buy companies at lower multiples. And on the next slide, we're able to do so borrowing less money. And on the next slide, that turns into higher rates of return. Why is that? It's because the companies that we're buying are, in general, small enough that they shouldn't be public entities. And the management teams often don't have the depth and sophistication that management teams of companies that are much larger have. And so the kinds of things that Ted was talking about and that Lauren was talking about, the skills that we can bring to these companies in supplementing or augmenting management, in introductions to new customers, in looking at acquisitions both domestically and internationally, in financing more efficiently, and in exiting in the most intelligent way. Those are skills that mid-market firms bring to mid-market companies that they don't have in-house. And they're skills that large cap companies often have already for themselves. And so that's why we think that this is a persistent and sustainable advantage as long as we can stay in this scale, which is why we do it.
Kneeland?
I think my colleagues have summarized things very well. I think that, given where we are in the middle market space, we also have even greater opportunity, not just here, but what we've found is many of our colleagues in other parts of the world, while LBOs, the large cap LBOs have played a role in Asia and other parts. There hasn't been that generation of deals in the middle market and lower middle market. And so many of these firms have approached us about partnerships and relationships in terms of cross-border opportunities. And I think you'll all, again, we've got plenty to do here. But again, there's also the opportunity to leverage the skill set that we have here more in a global place.
Well, I want to thank all the panelists today for joining us, and I want to thank you for being here as well. Thanks very much. Enjoy the rest of the conference.